My name is Patrick Kamau Kamure, and I welcome you to today's class. Today's lesson, subject that we are supposed to look at, is about public finance and taxation. Now, in the public finance and taxation, we are going to look at the topic of capital allowances, which is also called the investment allowance. So, when you talk of the capital allowance or investment allowance, it's good to make it very clear from the word go that this is a precursor to another topic that we are going to look at in a while, and I'm going to show you how it is connected to this topic of the taxation of the business income. Now, it's good to note that the capital allowance, as we compute it and in relation to the taxation, is usually used in place of something we call depreciation. Now, depreciation, you used to use it when you are doing your financial accounting or financial reporting. Now, when you are being taught about financial accounting and financial reporting, you are being taught to be an accountant. And now here, we are teaching you on how to become a tax person. So, for you to be able to connect, let us start from where you are using the depreciation in financial accounting and financial reporting. You remember this, you used to be given some information when you're doing your financial accounting and financial reporting, and you used to be told, like, prepare the profit and loss account or prepare the income statement. And when you are being told that way, you used to be given some information like sales, purchases, incomes, expenses. Then this is how you used to arrange your information to prepare the income statement or the profit and loss account. Here you used to come here and have the name of the business. Let us call this business ABC Limited. And then you used to come and say you want to determine the income statement. Income statement stroke profit and loss account. Profit and loss account. So for the period ended, you used to indicate, let's say 31st of December 20, you indicate there. You used to come and have, if you're given the sales, you write the sales here. Items are given, let's say, in shillings. So you used to come and post your sales there. And then you used to less cost of sales. And if you remember, although I don't want us to go into details, when you are getting the cost of sales, you used to say, let's say, opening stock plus purchases less closing stock minus drawings of the stocks by the owner of the business, and then you used to get the cost of sales, which when you took the sales minus the cost of sales, you used to get the gross profit. The gross profit there. And once you get the gross profit, you used to add incomes, other incomes. You used to call them other incomes. Other incomes. These incomes used to be discount receipt, come and place it there, investment incomes, you used to come and place it there, among other incomes that you could have been given, and then you used to less expenses. The expenses you used to deduct were like electricity expenses. You used to come and deduct them there. Salary and wages. You used to come and deduct it there. The rent expense. You used to come and deduct it there, among other expenses. But I want to remind you of one expense, and that is where we are today. The reason why we are doing this, and the capital allowance or investment allowance. Remember, if you are given, if you are told that the business purchased motor vehicle, I want to write it here first, motor vehicle, and they purchased motor vehicle for 10 million. Now remember, when the business purchased the motor vehicle, they are incurring an expense, you know, they paid the 10 million. So this is an expense to the business. They have spent money. Being an expense, I'm very sure if you remember, you didn't used to say that because it's an expense, you come and deduct it here. That is not what you used to do. In financial accounting and in financial reporting, what you used to ask yourself is, this is a fixed asset. Fixed asset, when you purchase it, it assists you to run the business in the long term. So you used to ask yourself, how long am I supposed to depreciate this motor vehicle? And the depreciation of that motor vehicle is the one that you used to come and bring it here, not the whole cost of the motor vehicle just because they have purchased the motor vehicle. So if, for example, you are told that the motor vehicle was being depreciated at the rate of 10% per annum every year, then that means that every year they were supposed to take 10% of 10 million, and that translates to 1 million. So once you determine that depreciation of 1 million, in this case, you used to come and bring it in the income statement and say, I have another expense, which is the depreciation of the motor vehicle. And now since we have determined it's 1 million, you used to bring it here, 1 million. And once you do that, you used to get the net profit or loss of the business there. And that is how you used to do it. Now, that was the financial accounting, financial reporting, when you are being taught to be a financial accountant. Now, we are looking at the taxation. Now, we are going to realize in our next topic that at some moment we'll be required to prepare the same statement. But the profit that we'll be getting down here won't be called just the net profit or the net loss. Actually, we are going to realize that that net profit that you used to get is usually called net accounting profit or net accounting loss. Why accounting? The name accounting, it means that it was being prepared by an accountant. So in taxation, we normally call it net taxable profit or loss. That is the profit or loss that is supposed to be subjected to tax. So now, when we get there, where we'll be getting the net taxable profit or loss, instead of net accounting profit or loss, we will realize this depreciation that you used to have is no longer required. It's not the one that is supposed to be deducted. Here, we will note an item like a motor vehicle, you are supposed to compute something called the capital allowance. We used to have, we are supposed to compute capital allowance or investment allowance. Of which case we are going to realize for the motor vehicle, the capital allowance rate is supposed to be 25%. So you take 25% of the fixed asset like motor vehicle 10 million, and that tells you that we have 2.5 million. So now instead of taking the depreciation here, when we are getting the net taxable taxable profit or loss, we will come and bring the capital allowance. Depreciation is not allowable. Capital allowance for the same motor vehicle. See now, it is not 1 million as per the way the accountant had determined. Now we have 2.5 million is the one that you come and deduct there. So now we want to see, this is just one fixed asset, the motor vehicle, of which case you determine the capital allowance the way you have determined so that you can come and deduct it here. How about in case you have other assets, like you have the furniture and fittings, you have the buildings, you have the computers, you have other items that are used in the business and which are supposed to assist the business in the long term. So how do you normally claim the capital allowance on them instead of depreciation, which was being determined when you are preparing the net accounting profit. So that is where now we are today about this topic of the capital allowance or investment allowance. So I hope you have understood it very clearly that the capital allowance or investment allowance is used instead of the depreciation, because depreciation is for accountant, not for the tax person, and it is usually computed in relation to the fixed assets like motor vehicle, furniture and fittings, the buildings, the computers and such. So now coming back to the capital allowance, we have said it is usually on fixed asset, and we have seen we have lot range of the fixed assets. It's good to know, as the rate we have said here about motor vehicle of 25%, now we have other rates which are applicable on other assets. Now when you are claiming the capital allowance, we usually have 4 rates which we are supposed to use when you are claiming capital allowance on fixed assets. I'm going to list those rates here, and then we are going to look at those items that we normally give the capital allowance at those rates I'm going to list. Like the first one, which are the items do we give the capital allowance at that rate? You go to the second rate, which items do you normally give capital allowance at that particular rate? The third one, the fourth one, that way. So these rates are rates for capital allowance. So these are the rates. We have number 1, capital allowance at the rate of 50% in the first year of use, and then 25% per annum straight line basis from the second year on the remaining balance. Number 2, capital allowance at the rate of 25% per annum straight line basis. Number 3, capital allowance at the rate of 10% per annum straight line basis. Number 4, capital allowance at the rate of 33 and a third percent into brackets, we call it a third per annum on costs straight line. Basis. So when you talk of the capital allowance, these are the rates that we normally use to claim capital allowance on the fixed assets that are used to run the business. So the next thing that we need to learn is when you talk of the 50% and then 25%, what do we mean? And once we understand what we mean, then in that case, then we look at which are the items that we normally give capital allowance at that rate. We go to the 25%, we do the same. The 10% we do the same, and 33 and a third percent or a third, we do the same. So I'm going to start with the first one, so I write it as the heading, and then we look at what do we mean by it, and then which are the items we normally give the capital allowance at that particular rate. So come. So here we are, the first rate for capital allowance. Capital allowance at the rate of 50% in the first year of use, then 25% per annum straight line basis from the second year on the remaining balance. What do we mean by that? Now, before we look at the items that we give capital allowance at those rates, this is what it means. It means when you have an item that we are supposed to give the capital allowance at that rate, first year, take 50% of the cost. And when you take that 50% of the cost, when you are determining the taxable income of that year, the taxable income, the income to be charged tax for that particular business, and you are preparing the statement I had indicated here. So the amount you are supposed to come and put here in relation to that asset, you take 50%. And when you talk of 50%, it doesn't matter of when it was acquired. If it was acquired at the beginning of the year, in the middle of the year, one day to the end of the year, it doesn't matter. As long as it was used in that year, you take 50%. And then that will mean that when you talk of now 25% per annum straight line basis from the second year, now from the second year you'll be taking 25% of whatever remain after you have claimed the 50%. And then it should be every year per annum. Per annum means per 12 months. So if, for example, you have reached the second year and an item is sold during the year, for example, in the second year you use it only for 6 months because it is disposed of. In that case, you are going to take 25% times 6 over 12 because the 25% is per annum. Per annum means per 12 months. But take note, for the first year 50%, we haven't said per annum. So in that case, it's going to be 50% period without considering the period it was used. That will mean if we have an item here, let's say it costed 100 million. It costed 100 million. Then somebody tell you that it is the one that qualify, although we are going to see those items that qualify at that rate, and somebody tell you that it qualify at the rate of 50, then 25, the rate that we have indicated there, and now ask you, can you get the capital allowance of the first year? So you'll come and say, ask this person, when was it acquired? Let's say the year we are considering is 2022, the 2022, and then you are told it was acquired on 1st of July 2022. Now, 2022 became the first year. So the capital allowance for the first year is going to be equivalent to, we have said, 50% of 100 million, without considering that it was used for just part of the year, which will give you the 50 million. So 50 million is the one that you're going to take to the income statement when you're getting the taxable profit and deduct it here in 2022. Then if somebody asks you, how about the capital allowance of the second year? How much is it going to be? Now the second year must be now the 2023. You'll come and say the capital allowance for the second year, which in this case we are talking about the 2023. If it was used the whole of 2023, it is going to be, we have said 25% per annum on the remaining balance after the first year. So how much remained after the first year? So the cost was 100 million. The first year capital allowance 50 is what was claimed. That means that the remaining balance is 50 million. Then if you take 25%, that is going to be 12.5 million. So in the 2023, when you are determining the taxable income of the business, you'll come and bring it here. How about in case somebody asks you about the capital allowance of the third year? The third year, in this case, that means 2024. How much will it be? In this case, we have said 25% straight line from the second year. That means that you take 25% again of per annum of the remaining balance after the first year. Remember, the remaining balance is after the first year. So you do the same as we did here. So the cost was 100 million, but the first year we claimed 50 million. So minus 50 million. So the remaining balance is 50 million. So when we take 25%, that is going to be again 12.5 million. So when you are getting the taxable income of the second year, you are going to take again 12.5 million of 2024 when you are preparing the statement. How about in case somebody tell you now, in the fourth year, this asset was sold mid the year. Let's say now we are talking about 2025. It was sold by 30th June of 2025. So how much will be the capital allowance? The capital allowance will be, that is now for the fourth year, and that is supposed to be 2025, is going to be equivalent to 25% per annum. Remember we said per annum means per 12 months, per year for 12 months. So now that it was sold during the year, by 30th June 2025, that means that it was only used for 6 months in that particular year. So in this case, when you talk of 25% per 12 months, now for the 6 months is going to be what? You multiply by 6 over 12 of the remaining balance after the first year. So the remaining balance of the first year was, the cost was 100 million minus what was claimed in the first year, that is 50 million. So you are left with 50 million. So when you take 25% of 6 over 12 times 50 million, this is the amount that you are going to get. So we will have 25%, you multiply by 6 over 12, 6 over 12, and then you multiply by the remaining balance after the first year, 50, and that is going to give you 6.25 million. And that is the one that you are going to take to the income statement when determining the taxable profit of the 2025. That is supposed to be the fourth year when you are getting the taxable profit there. So take note, the reason why we have said times 6 over 12 of 25 is because it was sold during the year of 2025. It was sold by 30th June 2025, meaning it was only used for 6 months. And because you are saying 25% is per annum, then you have to apportion it based on time. So that is what we mean by capital allowance at the rate of 50% in the first year of use, and then 25% per annum straight line basis from the second year on the remaining balance. Now, having noted on how we apply the rate of 50% and then 25%, the second question we should be asking ourselves is, which are those items that qualify for capital allowance at that particular rate? So that now, like now we have been using the 100 million to explain what we have explained here. Which this item was acquired at 100 million, the one that we should be claiming capital allowance at the rate that we have talked about. Which are those items? So that if you are given like 30 items, you know that this one is supposed to be under this rate. The other ones, maybe they are supposed to be for another rate, or they do not qualify for any capital allowance. So now we look at the items that qualify for capital allowance at the rate that we have talked about. So we have items qualifying for capital allowance at the above rates. What are those items? Items qualifying for capital allowance at the above rates are, number one, the following items: used in manufacturing. The key thing I want you to get from there, and these are the ones that we'll be using, these are the headings we'll be using to understand, is the term manufacturing. Manufacturing. So when a business is doing manufacturing and it incur the cost on the items I'm about to list, then they should claim the capital allowance at the rate of 50% in the first year, then 25% per annum straight line basis from the second year on the remaining balance. These items are A. Factory building, stroke industrial building, and the costs incurred that assist to use the building. To use factory stroke industrial building. Such as we have parking area, sewerage system, railway lines, electricity system, water systems, we have tunnels, bridges, etc., among others. So what we are saying is that if you are doing manufacturing, and you can see we are calling it the factory building because factory building, its purpose is to be used for manufacturing, or an industrial building, its work is to be used for manufacturing. So when you have the costs that were incurred to put up that building, give that cost the capital allowance at the rate we have indicated. We didn't stop there, but we also said also the costs incurred that assist to use the factory or industrial building. So there are those costs that are incurred in the process of using the building, or that are incurred in order to support the usage of that particular factory building or industrial building that has been set up. These costs are like parking area. You see, if you set up a factory building and you don't have somewhere somebody can come and park a lorry where goods can be now loaded into the lorry and be taken to the market, or if it is the raw material can be off-roaded, that building cannot be effectively be used. So you may realize you require a parking area. Another one is the sewerage system. So if you don't have a sewerage system in the factory, you may find that the waste product may not be eliminated from the factory system. So it will become kind of an issue. Another one are railway system, the electricity system, water system, tunnels. There are some factories which are usually connected through tunnels so that they can allow people to move from one part of the factory building to another part of the factory building, or from one factory building to another factory building. Others normally have bridges connecting them. All this is for the purpose of using that particular factory building. All those costs, when they are incurred, we normally give them the capital allowance at the rate of 50% in the first year, then 25% per annum straight line basis on the remaining balance from the second year. That is number one under manufacturing. Number two under manufacturing, B. We have the machine used in manufacturing, and machine that assists manufacturing, including cost incurred before the use of machines. So we are saying those machines that are used in manufacturing, including costs incurred before use of machine. The key things are these ones. Machines used in manufacturing, although I'm going to list them in a while. But here we are talking about used in manufacturing, like a processing machine. Processing machine is used to convert the raw material into the finished goods. That is one of the machines that is used in manufacturing. Not only that, but also machines that assists. The key thing assists in manufacturing. That means that these machines are not directly used to convert the raw material into the finished goods, but they help for that process to continue. And here we are going to look at some of those machines, but you can imagine one of them being like a water pump. Water pump is used to pump water into the system of the factory. So that means that water pump is not itself used to convert the raw material into the finished goods in the manufacturing, but it assists. Without pumping that water, the manufacturing cannot continue. So in this case, we are saying that those machines that assist in manufacturing also qualify for the rate we have talked about. Not only that, but also cost incurred, the cost incurred before use of those machines. This I'm going to list in a while, but they mean that you are incurring or you incur some cost before you started using a machine. A good example is you can purchase a processing machine, and maybe you purchased a processing machine through importing it, so you didn't find it locally, so you bought it maybe in Europe. Now when you buy that machine, it cannot be of any use. You can be told pay 50 million and you pay, but unless you transport it, it come into your factory, you install it, it cannot help you. So you may incur 50 million, that is the cost of machine, yes, but now you need to transport. Out of 50, you incur an extra 5 million to transport it. That's 55 million. When you are transporting, you are told by the transport company, you have to insure your machine. Maybe you insure for 2 million. You know, that's 57 million. So, and then when you bring it into your factory, you realize that you need to install it into your factory system so that it can be of use. So you hire an expert to come and install the machine for you, and this person tell you pay 3 million. In total now that is 60 million. So in this case now, when you are claiming capital allowance on that machine, you won't claim on the 50 million only. It will be 50 million plus the 5 million transport, plus the 2 million which was incurred insurance, plus the 3 million that was incurred to install that particular machine. So all those costs are put together and used to claim capital allowance on these machines that we have talked about here. So I want to give you examples of these machines. So we say example of these machines are, so these are the one, processing machine, we have water pump, packaging machine, conveyor belts, we have treatment plants, generators, etc., among others. As long as a machine is used in manufacturing or that assists in manufacturing like this one, you normally give it the rate we have talked about. I also want to give you a list of the expenses that could have been incurred before the machine was used, which you normally add them together when you're claiming capital allowance on that particular machine. So on the same, costs incurred before use are, these are the costs, are, we have transport, insurance, loading and off-roading costs, we have the installation costs, testing costs, etc., among others. But the key thing before use of those particular machine. Any, it can also include cost like repair. As long as it is incurred before use, we put them together when you are claiming capital allowance at the rate we have talked about the machine. But those costs that are incurred after you start using the machine, those do not qualify for capital allowance. We don't include them together with the machine when you are claiming capital allowance. Now we go to the third items that we normally give capital allowance at the rate of 50, then 25, as we had illustrated. This one is the C.